Welcome back to the channel, everyone. I'm Jay, and in today's episode, we're going to discuss the three biggest mistakes that most Americans make in their 401k plans. We all know that 401ks are probably the biggest retirement plans most Americans have today, with pensions kind of falling by the wayside and IRAs only having like a $6,500 per year limit you can invest into that retirement plan. All right, don't forget, it really helps, guys, if you hit that like button and subscribe to the channel, get us in the algorithm. Here's the video. Before we get into the three biggest mistakes that most people make in their 401ks, I just want to show you guys just how this interface works with your 401k. It can be very overwhelming at first. I know the first time I looked at it, I was like, this is insane. Like, how am I supposed to do this on my own? But you can do it on your own, and I'm going to show you how. Most of the 401k platforms you're going to use are going to be very similar to this. They don't give you a ton of information, so you really got to take the time and do the research on your own. All right, so our account's coming in right around 100,000 right now, and we have the Roth 401k. So what that means is we are paying taxes now so we don't have to pay taxes later. If you do the traditional 401k, that means you are going to do the opposite of that, is you're going to wait to pay the taxes to when you retire. But you guys have to remember, if you do have a Roth 401k, the only thing you don't pay taxes on is your contributions. Whatever your company's match is, you will have to pay taxes on that when you take it out. So say you have a 5% match and they match you even at 5%. So that means about half of your money that you get each month. So when we retire, say we get $10,000 a month, 5,000 of that will be taxable income. All right, everybody, here's the number one mistake that most people and probably you make in your 401k account, and that is using target funds. A target fund is say, I'm 37 now, I'm going to retire in about 30 years from now, so my target is like the 2055 target. So it's a mix of stocks and bonds and international exposure, and the rate of return compared to some other investments are not as good. Let me show you what I'm talking about. All right, everybody, we're going to do a deep dive into this 401k platform. In order to change the way your money is invested each month, what you're going to do is you're going to go over to the investment tab and you're going to go to change how future contributions are invested. You can also, whatever you're invested in already, if you have anything, you can change that as well here. Okay, I'm going to click on how future contributions are invested. And these are all the different funds that you can invest your 401k retirement into. Right now, 40% of my money each month, every 2 weeks, goes into the Vanguard 500 Index Fund, and 50% goes into the Vanguard Growth Index Fund, and 10% goes into the Vanguard Information Technology Index Fund. I'm going to show you guys why as we go throughout this video. But here are these target funds that I was talking about, and each year. But you can't even click on them, which is super annoying. All right, so what I'm going to do is I'm going to copy this and paste it into Google and find out what even is this Vanguard Target Fund. When we pop this bad boy into Google, this is what pops up, and we see that the ticker symbol for this mutual fund is VFIFX. That's something you're going to want to write down, have it somewhere so you can compare this fund to other funds and see which one is going to make you more money in the long term. All right, year to date, they're up 13%, which isn't bad, but if you look at 5 years, they're only up 15.46% in the last 5 years. That's like a compound annual growth rate of like 3%. And I think you want to get a little more than 3% over a 5-year period in your 401k. So this is a huge mistake. You don't want to be in these type of funds because 3% is absolute hot garbage. And I'm going to show you some of the other funds real fast and see how much they make over the same time frame. All right, everybody, what I did was I copy and pasted the Vanguard Growth Index Fund. That's the one fund that I have in my 401k. So I popped that into Google. Their ticker symbol came up VIGAX. So write that down next to the other one I told you to write down. Okay, now we're going to compare these two funds over time. So year to date, we can see the one on the left, the Vanguard Target Fund, is up 13%. Not bad. But if we look at the Vanguard Growth Index Fund, boom, year to date, 34%. Wow. And the best part is, we're going to get into this later. Look at the expense ratio, 0.05%. And the other fund, the target fund, the expense ratio is actually higher at 0.080%. To really understand how much money you're making or losing out on is if we go to 5 years. The Vanguard Growth Index Fund is up 82%. And then if we click on the 5-year chart for the target fund, it's up only 15%. So we go from a 3% compound annual growth rate to, it's going to be hard to get this kind of growth every year. So that's like 16.5%, guys. So if we even take the happy medium and say 10% each year, I'm going to show you guys on the 401k calculator the difference between a 3% compound annual growth rate and a 10% compound annual growth rate over the length of a 401k plan. Wait until you guys see this. It's going to make you absolutely go crazy to see the difference between a 3% rate of return and a 10% rate of return over the length of a 401k. So in this 401k calculator on nerdwallet.com, it's great to see the plug and play different numbers and see where you could possibly be at, when you're in your 60s. So I put in a base age of 25 with a median salary of $65,000 and zero money to start with, right? And obviously, as you get older, you're probably going to make a little bit more money, so these contributions will go up. But this is just a blanket summary, right? If you put in 5% of your paychecks with a 100% employer match at 5% and retire when you're 67 with a 3% rate of return, the investment return will be $764,000 that you will have in your 401k at the age of 67. Not too bad, right? Until you see this. You guys are going to love me for this, by the way. Boom! Oh my God! $4.91 million. So if you're 25 and you're making 65 grand a year and you have no money in your 401k yet, but you put 5% in each month, you get the 100% employer match and get 5% from them, and your retirement age is at 67 and your rate of return is 10%, at the end of your 401k at 67 years old, you will have $4.91 million in your retirement account. So there's a huge difference when you're talking about compound interest, guys. That's why it's so important to get your butt out of those target funds where you're only getting around 3% a year and get into something like the Vanguard S&P 500 index, man. Look at that, 4.91 mil. Woo! All right, now let's go on to the second mistake that most people make in their 401k accounts. One of the most common mistakes I see in people's 401k is not considering expense ratios when making their investments. Most people are like, hey, what's the difference between 0.25% and 0.5%? It can't really be that much money. Well, over 40, 50, 60 years, it's a significant amount of money, and I'm going to show you just how much. When scrolling through all these investment funds, it could be a super daunting task. So what we're going to do is we're going to compare the expense ratio of the Vanguard 500 Index Fund. And let's see, we like aggressive growth, right? Everybody likes aggressive growth. So we're going to go to the Cohen and Steers Real Estate Security Fund. The one on the left is the Vanguard 500 Index Fund, and the one on the right is the Cohen and Steers Real Estate Securities. We can see there's a significant difference between expense ratios. The one on the left is 0.04%. The one on the right is 0.75%, 0.75. Okay, let's plug them into our NerdWallet calculator and see how much money we're losing by investing in a company with such a high expense ratio. This first chart is our 401k balance at retirement with the Vanguard S&P 500 Index Fund with a 0.04% expense ratio. Okay, so we did this at a $65,000 salary, starting at 25 with zero in, with a 7% compound annual growth rate. So at the age of 67, when we retire, we're going to have $2 million in the bank for our 401k. But check this out. This is the specs with the 0.75% expense ratio. So we're going to lose out on almost $400,000. If these two funds get the same compound annual growth rate of 7%, our 401k balance at retirement will be $1.68 million with an expense ratio of 0.75%, nearly $400,000 less than the S&P 500 just because of the fee difference. The difference between 0.04 and 0.75% is significant, and we will lose out on almost $400,000 if we get a fund with the same compound annual growth rate with the higher fees. I want that 400k, don't you? The third and most critical mistake people make in their 401k is not taking advantage of the company match. Even if it's not an exact match, say you have to put in 5% of your paychecks to get 4%, you still should do it. If you don't do the company match, you're going to miss out on hundreds of thousands of dollars over the duration of your working career. So you have to take advantage of it. And even if you have a little less walking around money, you will be significantly more rich if you just suck it up a little bit and do the company match. Here's why. If your company offers a 401k match, I tell all my friends and family that you have to do whatever you can to max out your 401k. The company I work for makes us put in 5% of each paycheck for them to give us 4%. That's the max that they're willing to contribute. But in order to get that 4%, I have to put in 5%. So I'm going to do some math here for you guys. All right, everybody, we're back here on NerdWallet. We put in our contribution at 5%, and they're going to match 100% of 4%. So over the life of our 401k, the balance at retirement will be $1.85 million. Not too shabby. But look what happens if you do not get a company match for your 401k. So we're going to bring this all the way down to zero. Bear with me, guys. We're almost there. Boom, zero. Oh, boy. So we lost almost $800,000 in retirement money because we did not get a company match for our 401k. It is so important that you do this match because essentially you're going to have double the money in your retirement account when everything's said and done if you get the company match. Some companies do the same amount, like 5% for 5% or 4% for 4%, or some, like my company, we have to put in 5% and they will give us 4% if we max out at 5%. So if you guys like videos like this, hit the like button. Please leave us some comments below. Let us know what you're doing with your 401k. If you like these type of videos, please subscribe. It really helps the channel grow. And I hope you guys got a ton of information. And now you will be set to make a super buttload of cash in your 401k. Thanks for tuning in, guys, and we'll catch you on the next video. Peace!